Hello, my name's Victoria Hartley, Group Editor of Specialist Lending Solutions. Here with me today is Steve Seal, Managing Director of Bluestone Mortgages. Lovely to have you here, Steve. Now, Bluestone suddenly dropped its LTV cap to 75% in early June. Now, you say it's temporary, but what happened and how did you deal with the pipeline cases? Just take me through it, Steve.
Okay. And it's a question that I know a number of brokers will be asking, so it's a great opportunity for us to kind of respond to that. So I'll take those almost in reverse order. So in terms of the pipeline cases, any cases that we're currently working through our pipeline between 75 and 85% LTV, which was our old maximum, will continue to be processed as normal. So no change there at all, Victoria. Those cases will continue to work their way through and lead through to offers as brokers and customers would typically expect. In terms of what led to it, it's been something I think that's been building for a while. So from our perspective, in the specialist lending market and as a complex credit focus of that, we've seen an unprecedented demand for our products and services for about 12 months now. So since we came out of that first national lockdown in June last year, business volumes have absolutely been incredibly strong and surpassed anything we've seen from a pre-pandemic environment. Just to put that into context for you, if we compare January and February this year with January and February the year before, volumes were 90% up year on year. So that's a significant increase for any business to try and manage and clearly create some operational challenges. And we're very passionate about service. So what we wanted to do was to take a proactive measure that as we've seen that very strong demand put some pressure on our service standards, we wanted to take a really proactive approach to making sure that we managed that situation and just for a short period of time took a slight step back to allow us to pick up that shortfall and manage that pipeline and then come back to market strongly in a very short period of time.
Okay, thanks, Steve. But why the sudden move? Because it did feel a bit that way. And how long is the cap likely to be in place?
Yeah, so it probably does feel sudden to the market, probably less so to us as we've kind of been navigating this challenge for a while. I mean, interestingly, we did try alternative methods to kind of reduce the inflow of business over recent weeks. So a couple of weeks ago, prior to the LTV change, we nudged our interest rates up slightly just to try and take the heat out of some of the origination volumes that were coming in through the front door. But perversely, that had the opposite effect. And actually, after we changed our interest rates or increased our interest rates, we were actually seeing volumes higher than in the weeks prior to that point. So from our perspective, what we didn't want to do is just to allow that situation to continue, going back to that focus of being really passionate about service and wanted to take that proactive approach. We decided to reduce the LTVs just to allow us that short period of breathing space.
Okay, and to that passion, did you invest and did you add resource to actually try and deal with the backlog?
Absolutely. So in terms of adding resource, if we again compare year on year, our underwriting teams and our lending team and our sales team, both of those are around 70% higher than they were this time last year. So bringing those people into the business has been a real focus for us, but clearly that takes time and it's just managing that recruitment and the onboarding of those individuals whilst the volumes continued to grow over the last 12 months.
So how long will the cap actually be in place, Steve?
Yeah, so we've done some modelling. I mean, these things are never exactly perfectly scientific, but we expect the cap to be in place somewhere about 6 to 8 weeks. So a relatively short period of time, and then we'll be back out to market at 85% LTV.
It's an interesting point about, obviously, the sustaining service levels. It's everything to brokers, and brokers have been struggling horribly during the pandemic, trying to sort of struggle through placing cases for their customers in very difficult circumstances often. Why is it that lenders can't move as quickly as advisors would love them to?
Yeah, very fair. So I think just from my perspective, if we look at the last 12 months, so we emerged from that first national lockdown, started to see those volumes increase. And I can understand why brokers would want us to immediately start to resource the business at that point and start to bring additional people in to help us to maintain those service levels. I think from my perspective, because those volumes were so much higher than what we'd seen previously, we needed to be confident that that was sustainable and that those volumes were going to continue moving forward before we started to bring those people. Because quite rightly, that's a cost to the business, but also it's those people's lives when you're bringing them into the business. You want to be confident that those roles are sustainable as well. And it took us a period of time just to get comfortable that trend was going to continue for the foreseeable future before we made that judgment call.
Okay. And lenders measure service levels by processing times per case. So is there another or a better way to do it in your view?
I think so. I mean, I think they're perfectly valid measures. So there's probably a balance to be struck here, I think, between being clear and transparent with brokers in terms of how long it takes to navigate each element of the process. And that's a fundamental measure that we should rightly publish and be transparent about. But equally, I think there's also some real value in looking at how you measure the end-to-end journey. So regardless of how long it might take for one element of that process, if the overall application to offer period was market leading, would it matter if one element of it was perhaps a little bit elongated? And I think what we're keen to do is to not only be very clear about each element of the process, but to publish more robustly and more transparently that overall application to offer time and averages, so that we can be very clear about how long it will take the overall case to reach that offer point.
I think that would be very welcome. Yeah. I really do. The markets, especially in this market, of course, because the market's been rocket fueled by people sort of desperate for a life change and powered on by the stamp duty holiday. But how do you think current conditions have fed into this massive lending surge for Bluestone?
I think there's a number of factors that have led into it. So inevitably, we're seeing an increased demand for customers for complex credit lending solutions. No surprise, I think, because we're naturally seeing customers emerge from different stages of this pandemic with different financial challenges and having gone through different experiences over the last 12 months. Many of those customers need the support of lenders like Bluestone to facilitate their financial needs as they move forward and navigate the next couple of years. So I think you've got that market dynamic point and the growing market dynamics. I think the lender landscape is slightly different as well. So not all of the specialist lending landscape isn't an exact reflection of what it was in a pre-pandemic environment. And those factors kind of coming together, I think, are fueling the demand from consumers.
Interesting. And what is it brokers need to know about Bluestone's flexible credit policy? I mean, can you give me some concrete examples of cases showing what it can do?
The most recent change, I'll give you two. The most recent change, we recently amended our policy on self-employed borrowers. So a great example of where we can be innovative and work as a specialist lender to support customers coming out of the pandemic, where traditionally we would base our lending on customers' last year's trading net profits, as many lenders will. But I think we appreciate that over the last 12 months, there'll be a massive self-employed borrowers who will have had 2019 trading figures looking great, and will have suffered a significant reduction during 2020 due to the challenges of operating over the last 12 months and running their business during the pandemic with lockdowns and other restrictions. So what we've said to those borrowers is, if you can demonstrate in 2021 that you've returned to 2019's income levels for a period of 3 months, that will base the lending on 2019's income rather than 2020, rather than insisting that they navigate an entire 12 months again to demonstrate that level of income, if that makes sense.
It does, and that sort of fleet of footness, it will be really appreciated.
Yeah, so we've had some great feedback from brokers to that, because there's a whole host of self-employed borrowers who've suffered real challenges over the last 12 months. I promised I'd give you two, so I'm going to get my money's worth as soon as you're throwing questions at me. So another one would be, and I'm just trying to think of a case I was looking at the other day, where again it was a self-employed situation. A lady who was a shareholder, 25% shareholder in her estranged husband's business. Now, we would normally expect to see business bank statements for any self-employed borrower, but because of the relationship dynamics with her estranged husband, that wasn't achievable in this situation. But we could also see the PAY income from that business coming through. We could see the dividend payments and so on. So we were able to get comfortable with that income through alternative means. So rather than being rigid to that underwriting requirement about those business bank statements, we could take a more holistic and individual assessment of that client's circumstances and make a judgment call on that basis.
And what plans does Bluestone have for its broker partners this year in terms of service enhancements or anything else you'd like to draw out?
Yeah, so service enhancements is a really key one, bear in mind the topic of the conversation that we're having here today. So we've got some really exciting plans, I think, in terms of when we emerge out of this short-term period and return our LTVs back to normal. We've got some very exciting plans in terms of how we want to restructure the process and the way that we underwrite cases. I can't tell you too much, but I think everybody can be confident that if we travel through the next couple of months, there'll be some material changes to the way that we do that, which will streamline and improve that process even further. And as you would expect for any lender, clearly we've got plans in terms of product developments and so on. But again, we're very keen to grow and to extend the reach of our business and to support more customers where we can. But I'll let you know those details when I can.
Thanks very much, Steve. It's been brilliant having you here today. And thanks very much for watching Specialist Lending Solutions Television. We'll see you next time.